Now, since we are saying that transactions are daily business economic activities, so those economic activities that involves the exchange of value. So in this case, transactions, we have an item that we are exchanging with money, for example. So there's settlement of transactions or settlement of transactions. Now, a transaction can be settled in two ways. If a business is doing the exchange of value, let's say they are buying goods or selling goods, those transactions can only be settled in two ways. So in this case, we are going to look at a purchase or a sales transaction. So this is a business activity. Purchase is whereby now us or the business is buying goods from the supplier to be resold in the business. Can either be stock, inventory, that is going to be resold. So the intention of buying goods from the supplier is reselling, while sales is all the goods that are being sold to customers. In this case, we have purchase from our supplier, we have sales to our customers. So these transactions can only be settled in two ways. A purchase can be made a purchase on cash or a purchase on credit, or a sales on cash or a sales on credit. So those are two settlements of a transaction. So these can either be made in two ways, one on cash, two on credit. So on cash, this is where now, if we are buying goods from the supplier, we have settled the transaction immediately by paying cash. Okay, it's either we have paid cash through cash in hand or through bank, so bank transfer or cash in hand. So we have settled this transaction either through cash in hand or through bank transfer, check, credit transfer, all those, or mobile transfer, all those, they are trying to tell us that the goods were paid with cash immediately. So that's the first settlement. Now the second settlement of a transaction is whereby now goods have been bought or sold on credit. Now credit terms, this is an agreement that businesses engage with their customers that maybe they want to establish trust with the customers or to establish loyal customers by selling their services or their goods on credit terms. So on credit terms, in this case, the business may sell goods to the customers for the customer to pay within the agreed period. Cash hasn't been paid yet, just agree, sign like a contract. Say, okay, within 30 days, you bring the goods worth $5,000. If you are going to bring them earlier, like within 7 days, in the period of 30 days, maybe you are going to receive a cash discount. So businesses, they agree with their customers in this case. So customers can buy goods and pay later. Okay, but the challenge with this term, credit terms, has the advantages and disadvantages. And one of them, the business, they just want maybe to establish trust, establish loyal customers, okay, build their name with their customers. But the challenge that comes in this case, of which we are going to discuss, it's a separate topic, is that some customers can be reluctant to pay. If you have some customers who are reluctant to pay, that is going to distract your financial flow, your income flow. Because if you, let's say for example, you sold goods to customers on credit, customers are agreed to pay within 30 days, and you are expecting to record those transactions or to receive income at any point. So if the period elapses and customers are not paying or haven't paid within the agreed period, that can disrupt your flow of income. And if that continues until the end of the period, you find out you are going to make a loss because goods have been sold, goods have been taken out of the inventory, out of stock, but they haven't been, income hasn't been earned yet. So when you're trying to prepare a profit or loss, you find out those amount of goods are going to be regarded as expenses because those are called irrecoverable debts. Because in this case now, if you are selling them to customers, you have debtors. But if you are making them to suppliers, now they become creditors because these are suppliers that are offering goods to the business on credit terms. Debtors, these are goods, these are customers that are buying goods on credit terms to the business. So if they fail to pay these ones, they become irrecoverable debts. If the period elapses, they are accounting here has been finished, but our debtors haven't paid yet. Now they become irrecoverable debts, which are known as bad debtors. So they'll be called bad debtors, they'll be called irrecoverable debts, they'll be called doubtful debts. Okay? So credit terms, yes, they are good in the business, but you have to make sure that you are selling those goods to customers that can be trusted. So there has to be a credit analysis. So the business, they have to do a thorough credit analysis. So credit analysis is whereby now the businesses goes through customers to check through their financial history. If customers, they have a good capacity that they can pay the debts that they are requesting. So whereby businesses, they have to check the financial capacity of customers if they can pay the goods, the amount of money from the goods that they are requesting. Because if they have been making losses, we can assume that in the next period they cannot manage to pay. The same is also done with the supplier. They do credit analysis to the business. If the business is requesting goods to be paid or to be purchased on credits, the same, the business is supposed to do the same to customers, to request for the financial history of the customers if the customers can manage to pay the goods they are requesting. The reason why we are trying to do this, so that as time goes, we should avoid having the bad debtors, because these will make the business to have a loss. Okay, their goods bought, but they haven't been paid yet. There can be different reasons. Maybe the customers, they have moved to a different country. Maybe the customers, some of them due to death. Maybe some of them, they have become incapacitated, bankruptcy, as they are moving forward. So you can find out that they cannot manage to pay as time goes. So those become bad, doubtful, or irrecoverable debts. Okay. So to avoid that, businesses make credit analysis. Okay. Or they can also hire a debt factor. So debt factoring, in this case, they hire third-party companies who are specialized in factoring. So factoring is whereby now, let's say we have sold goods to customers to be paid later, okay, worth 5,000. Now, as time goes, they are becoming bad debtors. We can hire a separate company focusing on factoring, whereby they, for example, they say, okay, we are going to get the debts from the customer, but out of the debts that the customers have for you, we are going to request a 10% as our income of the debt, and then we'll give you 80%. Okay, so 20% to be ours, 80% of the debt to be yours. Factoring is just an agreement that you make with the parties. Can be people, can be other companies, factoring companies, that collects debts on behalf of the business and request a certain percentage that they take as their income and give the rest to the business if the debt has been collected in total. That's what factoring is all about. So all this just comes as a way of avoiding bad debts when goods are being sold on credit terms. So yeah, these are some of the ways that a business can settle for a transaction. In this case, it's a purchase and sales transaction. So whereby all sales or purchases can be made on cash or on credit terms. Cash can be cash in hand or through bank transfer, or can be made through credit terms. So if goods are being sold to customers, they become debtors. They are being sold on credit. And if goods are being purchased from the supplier on credit, they become creditors. Now, as time goes, if debtors, they have failed to pay back all the debts within the accounting period, they become bad debtors, also known as recoverable debts or doubtful debts, which is a loss to the business in their income statement. And then to avoid bad debts, businesses should do a thorough credit analysis to check the financial capacity of the customers if they can manage to pay back their debts. So they can also use debt factoring, whereby a third party can be used to collect all the debts, and they agree to take a certain amount from the debts if the debt has been collected, and then they pay the other half to the business. So this is about settlement of business transactions through purchase and sales.